Welcome to Talk Tickers. Today, we're digging into the puzzle that is TruBridge's second quarter earnings. The headline numbers sent some seriously conflicting signals, and we are going to break down exactly what's going on.
All right, so let's get right into it. This entire quarter really boils down to a paradox. You've got this real conflict between what they earned and what they sold, and it sent a super mixed signal to Wall Street.
And here's what I'm talking about. On one side, you have this absolutely massive earnings beat. We're talking a non-GAAP EPS of 54 cents. That's nearly double what analysts were expecting. But then you flip over to the other side and revenue came in a little light at $85.7 million, just missing the mark.
So, with these two conflicting pieces of data, how did the market react? Well, it zeroed in on that revenue miss and a little guidance tweak we'll get to later, and bam, the stock got hammered, dropping nearly 11% in a single day. A really decisive and honestly pretty painful reaction.
So yeah, that's the million-dollar question, isn't it? Is this a red flag? A sign of real weakness in the business? Or is there something more strategic going on under the surface? Let's dig in and find out what's really happening here.
All right, so first, let's look at the headline numbers. This is where you can really start to see the makings of both the bull case and the bear case for this stock.
Okay, this table really lays it all out for us. You can see revenue was basically flat compared to last year, and that's the number the market really punished. But the real story, the interesting part, is in those other rows. You see profitability metrics like adjusted EBITDA ticking up. And of course, earnings per share absolutely crushed it. But the one I want you to really pay attention to is the bookings.
And this was the big bright spot. TCV, that's total contract value of new deals they signed, hit $25.6 million. That's a solid 10% jump from this time last year. Now, why does this matter? Because this is the fuel for future revenue. It tells you that, hey, the demand for what they're selling is actually pretty healthy.
Okay, so here's where it gets really interesting. Let's get inside management's head. What was their story on the earnings call? You know, they didn't try to hide from the revenue weakness at all. In fact, they kind of leaned into it, framing it as part of a deliberate, strategic shift. Let's unpack what that means. The CEO, Chris Fowler, came right out and basically said, hey look, we're in the middle of a transformation here, and progress isn't always a straight line. He's really signaling to investors, look, this is a multi-quarter thing. We're focused on long-term health, even if it means we hit a few bumps in the short term. And here's that strategy in black and white. Look at the guidance. They trimmed the high end of their revenue forecast for the year, but, and this is the key part, they actually raised their forecast for adjusted EBITDA, for profitability. They are literally telling you, we are willing to sacrifice a little bit of revenue right now to become a much more profitable company. It's all about cost discipline.
And where is that discipline coming from? A lot of it is focused on fixing client retention in their CBO unit. That's their central business office, the part of the business that handles billing and collections for hospitals. And they've got a very clear three-step plan to turn it around. First, get smarter with resource management. Second, build out a presence in India to get more efficient. And third, bring in some new leadership with serious experience in this space.
But hold on a second. You might be thinking, if their bookings are up 10%, why on earth is their revenue forecast for the year coming down? And that is a great question. The answer is all about timing. It's one of those classic good problems to have that unfortunately creates a little bit of pain in the here and now. So here's the deal. Management explained that they're winning bigger and more complex deals, which is great news. But these bigger projects take a lot longer to get up and running, and you can't actually count the money as revenue until the service is live for the client. So you get this big delay between when they sign a deal and when it actually shows up in the financial results. It's a key growing pain of their new strategy. And this timeline just shows you how dramatic that difference is. In the past, a smaller deal would start generating revenue in just a month or two. Easy. But these big strategic deals they're winning now, they can take 6 months, maybe even longer to get going. And here's the kicker. It means the major wins from the first half of this year won't really start moving the needle on revenue until 2026.
Okay, so let's put it all together. You've got the market's knee-jerk negative reaction. You've got management's story about a long-term strategic pivot. And you've got these operational details about timing. So what's our take? What's the call on this stock right now?
Well, we're really weighing some clear positives against some pretty serious risks here. In the plus column, you have strong cost control, expanding margins, and that healthy bookings growth. That's all great. But in the risk column, you've got those client retention issues that absolutely have to get fixed, and there's huge execution risk. Can they actually get these big, complicated deals live on time?
So for those reasons, our rating on the stock is market perform. Basically, we think the price drop has it about right for now. It fairly balances that exciting long-term potential of a more profitable company against the very real short-term uncertainty and all those hurdles they have to clear.
Now, with that rating in mind, let's talk about the trade. And remember, this is not financial advice, but how could you potentially play this disconnect between the long-term story and the short-term punishment?
So how do you even trade a situation like this? The core tension here is that classic battle between value and momentum. The momentum traders sold off on the bad revenue news, but the value story, the underlying profitability, is actually getting better. And that gap, that disconnect, could be an opportunity.
So the whole thesis would be this, that 11% drop was a total overreaction. The market is punishing the stock for all the short-term risks, which is fair, but it seems to be giving them zero credit for the long-term reward. The potential for a much leaner, more profitable company to emerge in 2026 when that revenue finally kicks in.
Now, the entry point, the trigger to buy, isn't necessarily today. You need a catalyst. And for us, that catalyst would be seeing hard proof that their turnaround plan for that CBO business is actually working. The moment they report that client losses have stopped and retention is stable or improving, that's the signal. That's when the biggest risk starts to come off the table.
But what's the risk to this idea? Well, it's pretty simple. Time. If those big projects get delayed again, slipping further into 2026, or if that new team in India hits a snag, investor patience is going to run out pretty fast, and the stock could just sit there or even drift lower.
So there you have it. That's the story of TruBridge's quarter. It's all about short-term pain for a potential long-term gain. As always, please do your own research and talk to a professional. This is not financial advice.